TD Bank has recently announced that they are preparing to lay off a significant number of employees. This news comes shortly after Citibank revealed their plans to lay off 10% of their workforce, marking the largest restructuring at Citigroup in 2 decades and potentially resulting in 24,000 job cuts. This trend is not confined to just one bank, as Bank of America, Wells Fargo, and U.S. Bank have also quietly laid off approximately 20,000 employees each. If we take a closer look at these 5 banks, we can see that a total of 50,000 jobs have been eliminated in the banking sector in America this year alone. The question arises, why is this happening? The answer lies in what some are calling the biggest rug pull in American history. The financial system is currently facing a precarious and challenging situation that many people are unprepared for. To illustrate this point, let's go back to March 2020, when the Federal Reserve reduced banking reserve requirements to 0. This meant that banks had no obligations to keep money on hand and were instead lending out funds to consumers who were receiving money from various sources such as PPP loans, stimulus checks, and taking advantage of 0% interest rates. It seemed like everyone was making easy money through investments in stocks, cryptocurrencies, and even NFTs. However, that economic landscape has since changed, and now the banks are left facing the consequences. They are holding the bag, so to speak, and dealing with the aftermath of those riskier lending practices. The warning signs were there as Janet Yellen and Jerome Powell, among others, cautioned about the impending consolidation of banks and the challenges that lay ahead. They understood that the U.S. economy was heading into a massive Stage 5 hurricane, and perhaps prayers would be needed to weather the storm. In this video, I will delve into the details of this situation and provide you with a comprehensive breakdown of what is happening in the banking sector. The current state of the banking industry is alarming, as evidenced by the recent announcement of TD Bank cutting thousands of jobs and incurring restructuring charges. This news broke on November 30th at 6:48 a.m., shedding light on a problem that goes beyond just one bank. In fact, if we take a look at the developments in the banking sector over the past 7 days, it becomes clear that this issue is more severe than meets the eye. To provide some context, British banks have also announced significant job cuts just before the holiday season. This includes UK Metro Bank, which is slashing 20% of its jobs, amounting to 1 out of every 5 positions. Additionally, Metro Bank is targeting a cost reduction of $50 million. Barclays is another bank that has made job cuts, aiming to eliminate 2,000 positions as part of a $1.25 billion cost-cutting plan. Interestingly, Barclays has also created 900 new jobs, further indicating the turbulence within the industry. In addition to these layoffs, RBC Capital has lost 500 staff members. When we consider the magnitude of these job cuts, it becomes necessary to understand the reasons behind them. Banks are facing immense difficulties due to the economic troubles faced by consumers. However, the banks themselves are in an even worse position because of their investment strategies in recent years. The pressure imposed by low interest rates has resulted in substantial unrealized losses for these institutions. In fact, U.S. banks alone experienced a 22% increase in unrealized losses, reaching a staggering $683 billion and $900 million in the third quarter. One may wonder why this is happening. The answer lies in the dwindling savings of consumers. As of August 2021, consumers had approximately $2.1 trillion in savings. Banks were able to utilize this cash reserve for lending purposes, whether it be for purchasing cars, homes, or providing credit and personal business loans. However, as we approach mid-December, consumers will exhaust their savings, leaving them without sufficient funds. In recent news, approximately 43.5 million Americans are now required to start repaying their student loans. This means that individuals will have to make tough decisions regarding which bills to prioritize and which ones they will have to postpone payments for. Many will choose to prioritize their student loans, while others may opt to pay their credit card bills, rent, car loans, or other important expenses. As a result, banks will be left with a significant amount of unpaid liabilities, placing them in a precarious situation. To illustrate the gravity of the situation, bank profits have seen a decline of 4.6%. This can be attributed to the increasing expenses incurred from potential loan losses, which have risen by 33.2% over the past 4 quarters. The impact of the regional banking crisis is still being felt, and hedge funds demonstrate limited confidence in financial stocks, showing the least interest in them since 2020. experts are sounding the alarm about a credit card debt crisis, particularly during the holiday season when record spending is expected. According to the National Retail Federation, a staggering 200 million consumers indulged in holiday spending, even though a significant portion of them do not have $400 in their bank accounts. Despite the apparent lack of funds, consumers remain optimistic due to a belief that everything will turn out fine, as it has in the past. However, the reality is that the U.S. consumer has been facing a gradual decline in their financial stability. It may not be a sudden blow, but rather a continuous erosion over time. Looking ahead, it is likely that banks will respond to their own financial challenges by implementing more stringent lending restrictions on consumers. Each loan application will undergo intense scrutiny, leaving little room for error or leniency. As the banks struggle with layoffs and mounting losses, they will feel compelled to take drastic measures to protect their own interests. This will inevitably place a heavier burden on individuals seeking loans and credit. Consumers will need to navigate this landscape carefully, as the future of lending looks far more challenging and uncertain than before. The banks are facing a challenging situation, and as a result, they will become extremely cautious when it comes to lending money. This cautious approach is necessary due to the fact that many banks will start consolidating or even struggling to survive. It is a matter of concern for everyone. It is crucial to save and live within your means while planning for the future. Scala from New Jersey expressed how difficult it has been for younger Americans, like his son and daughter-in-law, who are entering the job market. They would love to buy a house, but the high interest rates prevent them from doing so. If we take a look at the current job market, we can see that the U.S. continuing jobless claims are skyrocketing. Furthermore, with $2 trillion in corporate debt that needs to be refinanced, corporations are going to face significant interest costs due to the difference in the interest rates at which they initially borrowed the money and today's rates. As a result, they will have to make cuts, and unfortunately, the employees will be the ones most affected. In most cases, office space will also be reduced as part of the cost-cutting measures. As we witness these changes, it is evident that jobless claims will continue to rise. Consequently, more and more people will struggle to meet their financial obligations. It is essential to pay close attention to the state of credit card debt and the overall situation of the U.S. consumer. By doing so, we can connect the dots between these developments and the actions of entities such as Blackstone and other large private equity firms. These firms currently hold a staggering sum of around $6 trillion in money market accounts, strategically awaiting distressed investment opportunities. To understand their approach, imagine you had a net worth of $100 million. Would you invest it right now, in 2023? Probably not. Instead, you would likely wait for a market downturn or a period of panic before deploying your capital to purchase undervalued assets like infrastructure or real estate. The same principle applies to these corporations. They have been liquidating stocks and accumulating significant cash reserves to position themselves for such opportunities during times of crisis when others are desperate for cash. In the current situation, when banks are in desperate need of cash, they are forced to sell assets at an unfavorable time just to gain access to the much-needed funds. For instance, consider the real estate market. Interest rates are soaring, ranging from 7.5% to 8.5%, depending on an individual's credit score. Few consumers are willing to purchase a home when they can rent a similar property at half the price. The combination of rising insurance and tax costs, as well as high and sustained interest rates, will eventually lead to a decrease in housing prices. It is unusual to see an increase in active home inventory during the winter months. Typically, inventory sees growth during the spring and summer seasons. However, the current trend shows that home sellers are concerned about the state of the economy and are contemplating whether they can afford to hold on to their properties if conditions worsen. These sellers are making decisions based on the need for survival. Private equity firms, institutions, and affluent individuals see this situation as an opportunity for strategic advantage. They are closely monitoring the economy, ready to capitalize on potential developments. The next few years present a chance for significant financial gain if one positions themselves well. With access to the internet and various opportunities that were not available to previous generations, individuals can leverage their resources to provide value and make strategic investments at a low cost.